Thatcher Taylor, welcome back to my classroom. We're going to talk 9 important dates. If you're over the age of 40, these 9 dates are coming up. Let's get into it. Hi, everybody. Let's talk about 9 important dates. We're going to dive right into it. As always, this channel is about education. If you have any questions, you can always email me, or you go to propathfinancial.com. That's my advisory firm if you ever want to talk to me directly. But we're going to go over 9 important dates. If you're over the age of 40, some of these are coming up, but these are 9 important dates that are going to be really valuable and really important to your success in retirement. So let's dig right into it. All right. So at age 50, you get to utilize catch-up contributions. So if you're making contributions to IRAs, 401ks, any other retirement plans like 457s or 403bs, you have the ability to do catch-up contributions over the age of 50. Now, the numbers have changed a little bit. So these are all going to be for 2022. If you're doing IRAs or Roth IRAs, you're making direct contributions, not conversions, contributions, your catch-up is an additional $1,000 on top of the amount of money that you can originally put in of $6,000. If you're in a 401k, 403b, and most 457 plans, it is $6,500 that you can start to contribute when you turn age 50. If you're in a simple plan, it's only $3,000. So if you're utilizing a simple, I don't see many of these, but if you utilizing a simple plan, it's an additional $3,000. What about a SEP IRA? If you're an owner of a business and you're utilizing a SEP IRA for your retirement plan, how much do you think your catch-up contribution is? And you're probably wrong. It's actually 0. Since it's the employer that makes the contributions on behalf of the SEP IRA, there's no additional catch-up. So that's just a little tidbit for you. All right, the next age is age 59 and a half. This is the ability to dive into retirement accounts or IRAs without penalty. Now, depending if it's a pre-tax account or a Roth IRA, what amount of money is actually taxable as far as earnings depends. But in general, at this age 59 and a half, you can start to access retirement funds, old 401k dollars, without penalty. I'm not talking about taxation on earnings. I'm talking about the 10% penalty for early withdrawal for any money out of those accounts. That's a really big date at 59 and a half. This really applies to people that want to maybe retire a little bit early and you need to focus on an income distribution strategy. Maybe 59 and a half is that date. So remember that date. It avoids the early penalty. All right, number 3. I threw this one in there. You don't see it very often, but for Social Security, age 60 is a very early age that widows or widowers can start to pull benefits from a spouse that has passed away. You don't see this a lot, but it's possible. Now, it's a reduced benefit. They reduce it down quite a bit if you take it at age 60. There's a calculation. You can find it online at socialsecurity.gov. I'll try to link that below. But age 60, widows' benefits can be accessible. Number 4, age 62. Age 62 is the 4th age. That's when you can start claiming Social Security. Now, before I said age 60 is widows. Now this is where you can get your own benefit and spousal benefits at age 62. As always, since it's before full retirement age, it's a reduced benefit. But also some other things to note at age 62, if you start taking your benefit early and you're still working, that additional work could reduce down your benefit. At 62, your benefit, your Social Security benefit, if you make too much money, can also be taxable. Now, some people take it at 62. It's a really good time for them to take it at 62. That's great. But be aware that 62, it comes with some caveats, but it's a date that you need to keep in your mind that that's when you can start taking Social Security benefits. Number 5, age 65. Number 5 is age 65. That's when you can start taking Medicare. Whippy! You got Medicare premiums, Part B and potentially Part D. If you're taking Social Security at this point, most likely your Medicare payments are going to come directly from your Social Security check. If you are not taking Social Security, your Medicare payments will be made from your checking account. They'll send you a bill in the mail. So you can access Medicare at age 65 But you need to be aware, if you're taking Social Security, it's going to come from those checks most likely. If you're not taking Social Security, you're going to have to pay the bill on your own. Now, Medicare premiums, Part B and Part D, there's a range. There's an income. It's called IRMA, IRMAA. So there's an income range on IRMA charges. Go ahead and Google IRMA if you want. I'll hit a link below of something that's IRMA related. But depending on how much income you make, the amount of the premium that you're going to have to pay could vary widely. Could be a little bit, could be a lot. I think the highest is $570 something right off the top of my head. That's for Part B. Part D is going to be a little bit less. I think the highest is going to be maybe like $70 to $80. The low end's like $12. I think the low end for Part B is $170. But do know you're going to have to pay IRMA if you exceed income limits. All right, the next ages are age 66 and 67. 66 is becoming less and less likely, but age 66 and 67 is full retirement age for Social Security benefits. That means that income number that I discussed at age 62, where if you make too much money, your benefit will be reduced, that's going to go away. So at full retirement age, you can get your full Social Security benefit and still work without having a reduction. Now, Social Security still may be taxable if you make too much money. So you need to be aware of that, the taxation of that, getting that pulled into your tax bill or into your income each year still may apply if you make too much money. However, the reduction of Social Security benefits goes away. But this is a great time to realize that you're going to get your full benefit based on the highest 35 earning years in your life. So just think about this really quick. The highest 35 earning years. So if you're in your 40s or even your 30s and you're watching this video, or even in your 50s and 60s, the full retirement benefit is based off your average index monthly earnings. So those years where you earned more, it helps bump up your Social Security benefit at full retirement age. Age 70, number 7. Age 70 is where you do not get any more delayed Social Security credit. So if you are 66 or 67, you're at your full retirement age, you have the ability to not take your Social Security. And then each year you delay taking your payment up to age 70, which is the last year, it actually increases your Social Security benefit by a pretty substantial amount, up to 8% each year that you delay. So age 70 is, you can think in your mind, the age where you're going to receive your maximum highest Social Security benefit. 66, 67 is your full retirement benefit. Age 70 is if you get some delayed credits, you wait a little bit longer. What I think about this when I think about age 70 is, are you healthy? Think about this. Are you exercising regularly and eating a lot, and you have good longevity, good genes in your family? Age 70 might be a number that you want to pay attention to so you can get that maximum benefit, because you assume that you're going to potentially be living longer. Age 70 and a half, number 8. Age 70 and a half is when you can take qualified charitable distributions. Now, not to be confused with required minimum distributions, which we will get to, but age 70 and a half is when out of your IRAs, your individual retirement accounts, you can take what are called qualified charitable distributions up to $100,000 a year can come out of your IRA and you don't have to pay any taxes. Let's dive in a little bit deeper. When you have an IRA, a traditional IRA, not a Roth IRA, take Roth IRA and throw it to the side. A traditional IRA or a rollover IRA. When you pull money out of that IRA, it most likely is all taxable as income. So you pull out $50,000 to spend, that money goes on your tax return as ordinary income. Qualified charitable distributions allow a person to take up to 100 grand out of their IRAs, send it directly to a charity. I'll link a video below about the procedure for that. Send it directly to a charity, and that does not have to go on your tax bill, on your tax return. It's a very valuable tool if you're charitably inclined and you want to protect from taxes. Maybe you got a little bit of extra money coming out of IRAs and you don't really need it. But it's a really cool tool. That's at 70 and a half. That used to be the same age as required minimum distributions, which here we are, number 9, age 72, required minimum distributions. This age was just changed to age 72 is the age where the IRS says enough is enough. Out of your tax deferred, pre-tax IRAs and 401ks, we want our taxes on it. So they require you to pool all that money together, all the pre-tax dollars together, find out your age based on 3 tables that they have based on your particular situation. You take that amount of your IRAs or tax deferred tax pre-tax dollars at the end of the year, you divide that by the divisor found by one of the tables, and that's the amount of money you have to pull out. That starts in the year that you turn age 72. Those are called required minimum distributions. If you like this video, please thumbs up, please subscribe, and even better, if you really like it, share it to your friends and family so they can subscribe too. I want to make more of these. We're getting a lot of traction. I love it. Thanks for watching.